Everyone's telling you to go big on Airbnb, 3 bedrooms, a pool, a games room, all of it. Does that sound familiar? But what if I told you that smaller properties are actually where the big money's at? So in this video, I'm going to be breaking down the surprising data, the money metrics, and real investor advantages that studios and 1-bedrooms have over larger short-term rentals. So if you want high returns without a 6-figure down payment, this strategy might just change the game for you. If you're investing in real estate in 2025, Airbnb still dominates the conversation. But here's what most people miss. Studios and 1-bedroom properties are smashing the numbers on occupancy, cost efficiency, and overall scalability. And yet they only make up 34% of US listings. That's a humongous opportunity. So let's break it down together. So let's talk numbers. Studios are averaging 58.4% occupancy, 1-bedrooms 57.7%. Now compare that to 2-bedrooms at 56.6%, 3-bedrooms 54.3%, 5-bedrooms down to 53.5%. So if you're chasing consistent bookings, not just seasonal revenue spikes, small properties are your best friend. And it gets better. Budget-friendly studios, not luxury, are seeing 65 to 68% occupancy. Hosts are actually getting more bookings from the most affordable listings. Let's zoom in on 5 major reasons why small properties punch way above their weight class. 1. Lower acquisition cost. No surprise here, a $250,000 studio is more accessible than a $900,000 4-bedroom villa. But here's the kicker. That little studio might still pull in 70 to 80% of the nightly rate of a larger place in the exact same area. That's incredible ROI for your dollar invested. Second, operational efficiency. Cleaning takes 30 minutes and not 2 hours. Furnishing it, way cheaper. Utility bills, way cheaper. Maintenance, much less cheaper. Half the size, half the cost. Quite literally. Even turnover supplies, sheets, towels, toiletries are simple to stock and restock. Third, faster turnover. With fewer bedrooms, guests stay shorter, and you can squeeze more bookings into each month. And thanks to their compact size, you can often tighten your booking windows, keeping your calendar fuller without breaking a sweat. Fourth, year-round demand. Solo travelers, digital nomads, business travelers, couples, they book regardless of what season. These are the guests who don't need a pool or 4 bathrooms. They need a good location, a comfy bed, and reliable Wi-Fi. Fifth, hotel disruption. As of January 2025, hotels are 31.6% more expensive than Airbnbs. Small Airbnbs deliver privacy, kitchen access, and workspace for much less. That value difference? Well, it's exactly what travelers are looking for. So, let's say you buy a $250,000 studio in a mid-sized US city. Your fixed costs are pretty low, occupancy is pretty high, and margins are strong. That's a lean, cash-flowing machine. Taxes? Cheaper. Insurance? Lower. Furnishing? Pretty simple. It's like owning a high-performance car that runs on half the fuel. And when it comes time to exit, well, you've got way more options in terms of buyers. First-time home buyers, long-term renters, other Airbnb investors. Small properties are far more liquid than a 1.2 million beachfront mega mansion. You're not locked into only selling to other vacation rental landlords. Instead, you have far fewer headaches with much more freedom to adapt. This isn't just an American anomaly. Small Airbnbs are dominating globally. South Korea, 71% of listings are studios or 1-beds. Thailand, 64%. Argentina, 62%. Cities like Seoul, Bangkok, Berlin, they thrive on compact rentals because space is at a real premium and demand is non-stop. Just like London. Now check this out. In the US, small units only make up 34% of listings nationwide, but in major metro areas, that jumps to 52%. Urban investing in small properties isn't just smart, it's aligned with global trends and travel behaviour. Let's talk resilience. When COVID hit, small properties dipped harder. Occupancy dropped about 30%, but they also recovered faster. By contrast, 4 and 5 bedroom properties were slower to bounce back and still haven't reclaimed pre-pandemic consistency. Small units prove one thing: when the market shakes, they stabilize quickly. So if you're looking for long-term revenue reliability, this is what it looks like. Let's wrap it up. Big houses got the headlines, but small units win the match. Lower startup costs, higher occupancy, stronger per dollar returns, faster recovery, greater flexibility. Look, you don't need to go big to go profitable. You need one clean, well-designed space that travelers love and a smart pricing strategy to match that. And that's how you build a scalable real estate income without taking massive, scary risks. If you found this helpful, subscribe for more data-backed investment strategies and insider insights from us here at AirDNA. We love breaking down real-world data-backed strategies to help you grow your short-term rental. Want to see how small properties perform in your area or what properties are actually for sale? Feel free to use the AirDNA link in the description down below. Anyway, thank you for watching and we'll see you in the next one.